Welcome, everyone. Wait a few seconds for everyone to come in. Good evening, everyone. Welcome to our Columbia University Alumni Club of Sao Paulo live webinar with our very special guest, Tobias Carlisle, straight from LA. It's not every day that we have an author of a #1 bestseller with us, so we're all very much looking forward to learning about his very unique and counterintuitive perspective on value investing. Our moderator today is our board member and his longtime fan and follower, Augusto Cesar Rodriguez, who is a lawyer by profession but has an alter ego with a blog on investing. Very eclectic indeed. Speaking of eclectic, we have had a very wide variety of webinars since March. They are all posted on our social media pages. Each event is posted individually with a link to the recording. You can find us on LinkedIn, Instagram, Facebook under Columbia Alumni Club of Sao Paulo, or by clicking on the links on the bottom part of all of our email invitations. Go ahead and follow us and like our pages. We post all of our upcoming events there as well. Just a few more words, if I may, regarding our upcoming events. Next week on Tuesday, September 1st, we will be receiving Eric Asher from Monashees, which specializes in venture capital and the famous unicorns. So this is another event that focuses on finance. However, on September 8th, we will focus on education with Claudia Costin and Jose Aliperti. So now, without further delay, thank you, Tobias, once again for dedicating this hour to our club. Augusto, take it away.
Okay, so I have to say a few words, very few words, because I know that everybody wants to learn more about value investing and the deep value approach. I have to say that Tobias is an excellent writer, has some excellent books. Everybody interested in the subject should read. To recommend few of them, I would say Deep Value and the newest one, that is the Acquirer's Multiple. And also, Tobias is a very generous user of Twitter that gave some attention to an avatar that is starting to do some tests of the deep value approach in the Brazilian market. And I'm very happy that he accepted our invitation to be with us today. So please, Tobias.
Thanks, Augusto. Hello, folks. Can you see me? Is my video up? I'm not sure if you can see me.
Yes, it's perfect.
Okay, let me just switch over to the let me switch over to my presentation, and then we'll get underway. The title of the presentation is The Acquirer's Multiple, and how it fits in with deep value, and I'll explain to you what those things mean very shortly. I've written a number of books and contributed to a number of others. The most recent book is The Acquirer's Multiple. Very grateful for Diana saying it's a #1 bestseller. I have to specify that it's a #1 bestseller in business and finance, which is a much smaller category, so it's much easier to sell a lot in that one. I've written a variety of others too. Deep Value is perhaps the one that I'm best known for, which is a longer version of The Acquirer's Multiple. I've written another called Concentrated Investing, where we interviewed a number of investors who had 25-year track records or longer of outperformance, who had done it using a value style and had concentrated, and we looked at the variety of ways that folks can build positions, hold positions over long periods of time, how they deal with concentration and diversification. And finally, Quantitative Value, which came out in 2012. I worked with a gentleman by the name of Wes Gray, who was a PhD at the Booth School of Business, which is widely regarded as the best quantitative school in the States, home to Eugene Fama of Fama and French. We looked at every bit of industry and academic research that we could find on quantitative value investment, looking for things that had worked 75 years ago that might have stopped working now, or things that continued to work the whole way through. Tested it all again, rebuilt a model, and we discussed that process in the book. I've also contributed to the Journal of Applied Finance, some introductory books on corporate finance, the foreword to the Fortunes book that you see there by Maurice Schiller, which is about special situation investing. And I've got some of my rules in Harriman's book of investing rules. I've delivered some variation of this talk in CFA-LA and the NYSSA, which is the CFA Los Angeles, CFA New York Society, pardon me. I've spoken about it at Harvard and Caltech and a variety of different places. The idea that drives value investing is a very simple one, and that is that all of the cash flows that you can take out of a business from here until the end of time can be valued and discounted back. And that's Buffett's quote right there from a book, The Theory of Investment Value by John Burr Williams. It came out in 1938. It's still the case. That's still the way that all assets are valued. It's an easy rule to say. It's a difficult rule to implement, and I'll demonstrate why as we go through. In 1955, Benjamin Graham was hauled before the Senate Commission into the stock market. That had been a recent stock market crash, and folks wanted to know why stocks crashed. And then one of the committee chair was asking Graham about how Graham went about investing. For those who don't know, Graham wrote Security Analysis, which is regarded as the initial codification of value. He wrote down the rules. It's an old book. It's about railroad bonds. It's not particularly applicable. The technical detail is not directly applicable today, but the ideas in it are very powerful and continue to be applicable. And it's been updated a number of times. I think it's on its 6th edition now. I've got 3 of the editions, and it's sort of a personal statement of your own investment philosophy. Which one you prefer? I prefer the original because it discusses some of the more deep value ideas, which were then more popular. But in the course of this Senate commission, Graham was asked, when you find these things that are undervalued, how do you bring about, how does it go back to its valuation? How do we actually make money out of this? And he gave one of the great answers, which is true but unhelpful. And he said, nobody really knows. It's a mystery. But he's being a little bit coy because we do have some idea what happens. And it's this microeconomics where when something gets overvalued, fewer people will buy it. Some people will short it. That tends to bring it back to its underlying valuation. When something's undervalued, fundamental investors like me or private equity firms will buy these companies and push them back up again. But I like to give this little woodcut, which shows 3 sort of half donkey, half men figures clinging to Fortune's wheel, and it's Fortuna who you can see the hand sort of pulling the wheel, and there's one donkey ascending, one donkey at the very top reaching for the sun, and that donkey's name is Regno. That's Irene. He doesn't know that he's just about to, he's about to descend down the other side, but the man with the donkey head going up on the other side is I will reign. Off the bottom is Sum Sine Regno, I am without a kingdom. And then Regnavi, I reigned. And so it's this idea that at the very top of the business cycle, at the very top of when stocks get very, very expensive, it seems like they will continue going on forever. When what is much more likely is that we will see some mean reversion and the multiples will contract and the profitability will reduce. And it's true also at the bottom when it looks darkest, often that means that smaller companies that can't survive, companies that aren't as well capitalized in an industry tend to leave the industry. And then the industry goes through a period of supernormal profitability. And it's difficult for folks to see that coming beforehand, which is why the expensive stocks tend to get more expensive for a period. Cheap stocks tend to get cheaper. But if you have that idea that you are likely to see some mean reversion, then you can invest anticipating these things, and it's a powerful investment strategy. And this is a simple analysis of the French data. So you can find on Ken French's website, all of this data is available for free. The data runs back to 1951 for price to cash flow. These are price to cash flow portfolios. He has data for price to book value, price to earnings, and he has divided them into quintiles or terciles, which is divided into thirds, deciles, divided into tenths. I use the quintiles just because it's easy to see. You get the idea. the cheapest portfolios, those with the highest price to cash flow. It's kind of hard to imagine what that means, but it's basically that you get more cash flow per dollar over the full period have performed the best. You've generated 14% compound, and the glamour portfolio, which tend to be the most expensive stocks, they've tended to underperform the market. But that's not always the case. We're going through a period now when the most expensive stocks are outperforming and value stocks are underperforming. And it's that the fact that it doesn't work all the time, I think, is one of the reasons that keeps value investing evergreen. This is one of the unusual phenomena that you will see in deep value stocks. And this is the explanation for why these stocks get so overvalued or undervalued. This is from a study that came out in 1987 by DeBont and Thaler. Richard Thaler has a Nobel Prize now, as does Eugene Fama, for this observation. So these are portfolios constructed for price to book value. So they're trying to find the cheapest companies on a price to book value basis. And what they show is the earnings over the 3 years prior to the formation of the portfolio. So you can see the undervalued portfolio, the earnings have been falling. And what they've done is they've rebased all of the earnings to 100 on the portfolio selection date. The overvalued portfolio, all of the earnings have been increasing, which is why the overvalued portfolio gets overvalued. And the falling earnings describes why the undervalued portfolio gets undervalued. Who would buy the undervalued portfolio when you can see the earnings have been falling? And of course, you want to own the overvalued portfolio because the earnings have been increasing. Here's the wrinkle. In the years that proceed on from the portfolio selection date, it tends to be the earnings of the undervalued portfolio that tend to do better, which is unexpected. Part of the reason is, in my opinion, we're looking at the business cycle here. When you see rapid increase in earnings, you're seeing something approaching the top of its business cycle. And when you see earnings falling, you're seeing something approaching the bottom of its earnings cycle. This is in aggregate on an average. This doesn't apply to every single company, but it's worth bearing in mind when you find something cheap with falling earnings that there's a very good chance that there's some mean reversion coming. So now let's explicitly look for what many value investors say that they do. So many value investors will say, what I like to do is I find something that's undervalued, but with increasing earnings. And they might call that high growth value. And that's the orange in the top left-hand corner. If you're an investor like me, contrarian value, what you like is sort of lower earnings growth to go along with your cheap stocks. You could also find expensive stocks that have very high growth. That's a glamour stock. And then in the bottom right-hand corner, the skull and crossbones. That's an expensive stock with low growth. Those do exist. That's Tesla right now is an expensive stock with low growth. The skull and crossbones indicates that that's perhaps not the place that you want to be invested, but I'm going to show you why. This is just some detail on what we're seeking to do. So the glamour stocks, which you remember are the expensive stocks with the very high growth. You can see the earnings, that top left-hand table box, the earnings have been growing at 18.7%, and you're currently paying a 19.6 times multiple for those stocks. So they're expensive, but they're growing very quickly. The high growth value stocks, they've been growing at 16.9%, so not as fast, but you're getting a much lower multiple for them, a 6.3 times. And the contrarian value stocks, over this period of time, they had been growing quite quickly, 9.7% on an annualized basis, and you're paying a 6.5 times multiple. You can just cast your eye down over the cash flow, book value, operating earnings, all indicating high growth for the glamour stocks and a high multiple, high growth for the value stocks and a lower multiple, sort of middling to low growth for the contrarian value stocks and a lower multiple. And now you might guess which one you want to, which of those three where you'd like to place your bet for which will be the best performing stock over or best performing portfolio over that period of time. The high growth value certainly does outperform the glamour. That's very clear. The driver of the performance turns out to be the multiple expansion rather than the underlying earnings growth. But here's the wrinkle. The contrarian value did the best over all of them. So there's no reason why you should be afraid of lower growth, provided you can get a sufficiently cheap multiple for the stocks. So I just wanted to focus again to compare the two. As you see, the high growth value seems to be, in some instances, it's cheaper than the contrarian value. But if you look at the book value, they were 0.3 times book, which is a little bit more expensive. And the high growth value is 0.3 times book, a little bit more expensive than contrarian value at 0.2 times book. So just to focus on this a little bit more, there was an analyst, Michelle Clayman. She did this study. It came out in 1994. It just followed on from the release of a book by Tom Peters called In Search of Excellence, which is widely regarded as one of the best business books ever written. Peters found this list of companies that he and his business partner regarded as excellent businesses. And they looked at the quantitative characteristics of these businesses. And he said, as a cohort, the asset growth was 21.78%. They're all, you can see as you go down that list, they all grow very quickly, but the price to book value, they're all expensive at 2.46 times. Michelle Clayman created this sort of as a joke, or to sort of show the problem with paying so much for these stocks. She created what she called an unexcellent portfolio. And all of these had much lower asset growth, much lower equity growth, much worse return on capital, return on equity, return on sales. However, they tended to be much cheaper there. They're about a quarter as expensive as the excellent companies. Just so you can see that. So I reached out to her analyst, Barry Bannister, who's now the head of research at Stifel, and I asked him to update this study. And this is what Barry found. This is through to 2014 when Deep Value came out, because this is from the book Deep Value. Basically, it shows that the unexcellent portfolios massively outperform the excellent portfolios. The excellent portfolios actually underperform the S&P 500, which is sort of striking. That really what is driving this is multiple expansion and compression. So the question that Barry got asked, and that he was happy to share with me, was, is there some reason for owning the excellent companies? For example, do the excellent companies tend to work better in these bad states of the world? So that the way that Barry defined bad states of the world is when economic growth is below average. So he said the global average of growth from 1970 to 2012 was 3.65%. When it's above that, that's a good state of the world. When it's below that, that's a bad state of the world. The black indicates when unexcellent stocks are outperforming, and white indicates when excellent is outperforming. As you can see, there's no real rhyme or reason. There's no additional protection in bad times from excellent companies. There's really no reason to own them other than the fact that they tend to have very compelling stories attached to them. And so that brings us to the driver of these returns is mean reversion. And it's mean reversion both at a company level, when we see the business doing better or worse, and it's mean reversion for the pricing when we'll see discounted stocks catching up to their underlying value and expensive stocks catching down to their underlying value. The difficulty in implementing strategies like this is they're extremely hard to implement emotionally, behaviorally. And so we look for some simple tools to help us implement these strategies. This is a study that was conducted at a teaching hospital where evidently when folks appear for admission and they have some form of psychosis or some form of depression, very bad depression can manifest as a form of psychosis, and it's difficult to distinguish between someone who is depressed or who has some sort of psychosis. And so they administer these questionnaires, and they had the doctors who were treating make a determination, and then when they presented, and then subsequently 2 weeks later, when they'd gathered more information, they were able to make a better determination, and they were able to work out how accurate that initial determination was. So the worst psychologist was doing a little bit better than flipping a coin. Average psychologist gets it right about 62% of the time. The best psychologists get it right about 67% of the time. But then Dr. Goldstein, who conducted this research, he created this simple questionnaire that had about 6 questions on it. And he found that simple questionnaire got the diagnosis right about 70% of the time, which was better than the best psychologists. So what they then did was they ran a second study, and they gave this simple model to students who were in the hospital learning, and to doctors who were treating patients. So the inexperienced here is the student. They got it right about 59% of the time without the aid of the model. The experienced teachers got it right about, the experienced doctors got it right about 64% of the time without the aid of the model. When the students were given the model and allowed to exercise their discretion over implementing the model's decision or not, they got it right about 67% of the time. So they did improve their accuracy, but they still didn't do as well as the experienced teachers who had now the benefit of the model and their own experience. But here's the really odd thing. The model by itself still outperformed both the experienced and the inexperienced when they had the benefit of the model. And the reason is this phenomenon known as the broken leg. This is the way we describe it. So broken leg theory, the way that it's described in the literature, let's say we have some idea, we have a simple model to determine whether somebody will go out to see a film on a Friday night. And we might factor into that model such things as, are there the type of movies, is it an action movie? Is it romance? We might look at the weather. Is it raining? Is it clear? Are there other things on? We might include those in our model, and then we might come up with a decision, and then we see the behavior of the person who's the subject of the test. Do they then go and watch it, or do they not? Are we correct? Is our assessment correct? Are we guessing correctly? Let's say we have this additional piece of information. Now we learn that the person has a broken leg. The question is, are we allowed to override the model to include this piece of information that seems very important, that's not included in the model? And the answer is we're not. And the reason is we tend to override the models far too frequently. We exercise our discretion too often. We find too many reasons why we think the model's wrong, which is why we tend to underperform the model. In sort of demonstrating, bringing this back to finance, I want to use this excellent little book, The Little Book That Beats the Market by Joel Greenblatt. You've likely heard of it. It's one of the most popular books ever written on value investment. The theory is very simple. The idea is that it's based on Warren Buffett's investment strategy. Warren Buffett says he likes a wonderful company at a fair price. And Greenblatt has tested this quantitatively, and he finds that it outperforms the market. We confirm the same thing in the book Quantitative Value. It does in fact outperform the market. So Greenblatt ran this interesting study, and he wrote about it in an article that appeared on Morningstar, where he had this formula investing firm where folks could come in and they could sign up for an account. And he had two types of accounts. You could have a self-managed account where you were able to cherry pick whichever stocks that came out of the model that you liked and ignore the ones that you didn't like. And they had some automatic accounts. In the automatic accounts, the system just bought every stock that the model recommended, and it did it without fear or favor. What they found was that the automatic accounts, over the roughly 2 years that they ran the test, the automatic accounts did materially outperform the S&P 500, which is what the model expected to happen. The self-managed accounts underperformed both the model and the S&P 500. And the reason is that folks went through and they picked up the stocks that they didn't like, and it was those stocks that tended to drive all of the performance. And that's an example of exercising your discretion to override a model that has a demonstrated ability to outperform the market, and then to underperform both the model and the market. And this is Greenblatt. If the question's always, well, that's someone who's an amateur investor. What about someone who's an expert? Greenblatt himself said, we tried to override the model. We didn't do a very good job, and we're good analysts. And that's an understatement. Joel Greenblatt's a very good analyst. And so this is the golden rule. Simple models outperform experts, even when the experts have access to the simple model's output. And this is true across not just investing. It's something we find in the social science research over and over again. So let's go specifically to the acquirer's multiple. I always put this little painting up, Sessi Nespa und Pipe. This is not a pipe. It's very clever. It's not a pipe. It's a painting of a pipe. And I always put this up just to remind folks that what we're doing is we're creating a model. It's not reality. We're trying to create our own estimate of what a company is going to do, but we have to remember that it's not reality. What we're trying to do is, as close as we possibly can, perhaps with as much conservatism as we possibly can, estimate the intrinsic value of something, and then see how it goes from that point on. This is more relevant when I'm speaking to folks who create Excel spreadsheets that have multiple tabs. They've dedicated themselves to the creation of these incredibly baroque, detailed models for valuing companies. And I think sometimes that perhaps they lose sight of the fact that the map is not the territory. What we're creating is only a model. And it's important to have some conservatism in the model. And it's also important to refer to the outside view. And there's lots of good information. So Michael Mauboussin has done some great research where he shows the sort of returns that you can expect from different industries, the sort of growth rates, returns on invested capital, and so on. And you, at the very least, your model should have these sort of outside influences on it. So you don't find yourself compounding some earnings out to the horizon at a very high rate, when we know that what tends to happen is growth tends to slow. There's some mean reversion. We'll see some competition. Returns on invested capital tend to drop. If you include those in your model, you'll find that the models get more accurate and they become more useful. And this is the other rule that's very important. It's important that we have simple, concrete rules. So the reason for that is that it becomes too easy to exercise our discretion when the rules aren't simple or concrete. That's sometimes where it can slip through. You need to be able to look at an output from the model and then make a decision on the basis of that. And Seth Klarman says it best then. Folks seem to be striving for certainty and precision when often these situations are accompanied by high uncertainty. And when you find these low prices with this high uncertainty, if you can make a quick decision, sometimes you have the advantage. This is another very simple model, the net current asset value model. These are sometimes known as net nets. This is from the 1928 edition of Security Analysis. The idea of the net current asset value is it's a rough measure of the liquidating value for a company. So this is what it's worth if the business is ceased and the company is wound up. For many companies, you'll find that this is a negative number. There's a very few companies that will make it through a screen like this. It's probably the dourest, it's the most conservative assessment of value for a company. For many companies, this will be not a useful measure, but there will be occasions when you find companies that are cheap on this basis. And the idea is that you buy them at 2/3 of their liquidating value or less, which is incredibly cheap. Very little passes through this screen. The returns to this simple model have been spectacular over very long periods of time in various different locations. It's a very solid model for investing. And it's a good one for demonstrating deep value because these aren't companies that have compounding. The businesses are terrible. That's the only way that they get this cheap. But the returns can be very good. And this is one of the things that you need to bear in mind as a deep value investor, that very good returns can be achieved from very bad companies. It's not necessary that the business be excellent. Bad businesses can generate very good returns. The thing that you're looking for is a big discount to intrinsic value. But this is in the aggregate, it's the reason that these things get cheap and the reason that folks don't like investing in them is because they do tend to be more likely to fail than the average business. So this is some research from James Montier, net nets as they're sometimes called. They're about 2.5 times more likely to fail. But the portfolio tends to do better than the market most of the time. And this is the other very odd thing about these stocks. The ones that make losses tend to do better as a portfolio than the ones that make profits. And among the profitable ones, the ones that don't pay dividends tend to do better than the ones that pay dividends. It's a very unusual part of the world to be invested. they're extremely counterintuitive, and sometimes it's difficult to understand why it works the way that it does, other than the fact that the reason that these things get very cheap is that nobody wants to own them. In some ways, this it's a reflection of Buffett's own trajectory as an investor. He started out as a liquidator, and many folks may know the story of Sanborn Map, which they produced these fire maps for insurance companies so that they didn't need to go to to each building to work out the likelihood that the building would burn down. As the maps aged and became out of date, they would be updated by sending a sticker, and you would put the sticker over the top of your map, and then you'd be able to update your view on the likelihood of any given building catching fire. Business had been very good for a long period of time. They hadn't become digitized. They hadn't done anything else. They were superseded by other better technologies. They'd taken all of the profits from the business and they'd invested it into this portfolio of securities. And so the business was worth almost nothing, but this portfolio of securities was very valuable. But the folks who sat on the board of this business were the insurance companies that bought the maps from the map maker. And so they didn't want to stop the business because they were not paying enough for their maps, and they didn't want it wound up either. Buffett got control, forced them to liquidate, and his investors did very well. And so that was one of his early forays as a liquidator and sort of something like a corporate raider. In 1963, he had an American Express investment, which much more famous. I'm sure lots of folks know that, but I'll just recap that very quickly. There had been the great salad oil scandal, where a gentleman had filled up these barrels with seawater and had this device that made it appear as if they were filled with salad oil. American Express had issued the warehouse receipts certifying that the barrels did in fact contain salad oil, which he'd then used to borrow and speculate further on salad oil. At one point, he owned more salad oil than there existed in the entire world, according to these receipts. The fraud was discovered. The salad oil market collapsed. He was bankrupted. His broker was bankrupted. And folks looking to get their money back came to American Express, which did seem to have deep pockets and had issued the warehouse receipts, which seemed to be fraudulent. American Express cratered, and Buffett started buying American Express. And the reason that he owned it was that he thought that the value of the business was in the business rather than in the balance sheet, and that folks would in fact continue to use the credit cards when they went to restaurants to eat out. The restaurants continued to accept the credit cards. He thought that the American Express card would continue to work. It turned out he was correct. The business recovered, the stock recovered, and he did very well. But it was after that period when it recovered, when it continued to grow, that he had this epiphany that it was better to own these wonderful companies at fair prices than great companies at wonderful prices. That wasn't the end of his corporate rating, though. He still raided Berkshire Hathaway, which was a classic Graham net that had all of its wealth tied up in the machinery on the shop floor. He got control, and Berkshire Hathaway continues to be his investment vehicle to this day. After he owned Berkshire Hathaway, he got control of See's Candies through blue chip stamps, which is how he learned about the value of brands and franchises. And that's how Buffett becomes today the investor that he is, which is quite a long way from the liquidation value investor that he started out as. So the lesson that he learned from See's Candies was that he wanted to avoid the cigar butts, and he wanted to focus on these wonderful companies at fair prices, which is the same thing that Joel Greenblatt said that he preferred when he studied what Buffett had done. So let's just discuss very quickly what that means. So a wonderful company at a fair price. A wonderful company has a very high return on invested capital, a very high sustainable return on invested capital. And that's important. We'll come back to why sustainable is so crucial in a moment. And a fair price, let's say let's say a fair price is a high EBIT operating income on enterprise value. So I call that the acquirer's multiple. Basically what that means is that you're paying less for every dollar of operating income that the business generates. So this is a test that we conducted for quantitative value, the book that came out in 2012. The magic formula itself, when you throw all of the gold standard of academic back testing at it, so we weight the positions according to their size. So this is not a function of these only being small capitalization companies. We we lag the data. So we assume that you can't trade until June based on the year-end data. That's to make sure that any earnings updates and so forth are properly disseminated to the market. Even doing that, even applying all of those rules to this formula, Greenblatt's magic formula does materially outperform the S&P 500. It's a good formula. Buying things cheaply that are good is a good way of investing. But here's the wrinkle. If you only use return on invested capital, you reduce your returns quite materially. It's still a good way to invest. Identifying very good companies is still a good way to invest. It does tend to outperform the market because the market contains businesses that aren't very good businesses. But the problem is that most of the return, in fact, more than all of the return, comes from this EBIT on enterprise value, the operating income. The cheap part of the formula drives all of its return and more. And just to show that it's there's nothing special about the weighting. So here we assume we start from on the left-hand side, return on invested capital only. So that's 100% weighted to the quality factor, nothing at all applied to the value factor. That does the worst out of this cohort. As we add more of a value weighting to it, we get increasingly better returns. At the 50-50 mark, we've got the magic formula, and it's about halfway in terms of performance, and then performance gets increasingly better until we get to the operating income on enterprise value, or as I call it, the acquirer's multiple on the far right, which does the best. This is a log chart of the full data set. This is from the acquirer's multiple book. You can see it's a pretty consistent advantage that the value companies have over the high quality companies, but that's not always the case. There are these moments where at pretty historic bull market tops where the better companies do much better than the cheaper companies. And so there was one in 1982. There was a very notable one in the late 1990s. That's the dot-com boom there, where you can see that the more expensive companies did much better for a period of time and the value companies suffered. And we're going through another one now where the very high return on invested capital companies do very well and the value companies suffer. It happens regularly. I think that the world will return to normal in due course, but I don't know when. This is just taking away the log chart so you can see that what you actually end up with over the full data set is quite a material outperformance for value, even though you can see quite clearly that value has struggled over the last 5 years or so. These are the statistics, just so that you can dig in and see that it is not just a story of better performance. It tends to be better risk-adjusted performance too, to the extent that that's important to folks. The Sharpe ratio, which is just the outperformance over the standard deviation. Sortino is outperformance over upward standard deviation. In every case, the cheaper companies tend to do better than the higher quality companies. So what drives it? Again, it's mean reversion. The very high return on invested capital companies tend to see this mean reversion over the period of time they're held. This is a chart from Michael Mauboussin from his book, The Success Equation. He updates this regularly. He updates it on a rolling 10-year basis, and he takes the top 1,000 companies, divides them into 5 buckets. The top bucket in the dark black line there are the companies that have the highest return on invested capital. The bottom ones have they're loss makers. They have a negative return on invested capital after backing out weighted average cost of capital. And you see over the course of the decade, there's this very material mean reversion where the very best companies become less good. The very worst companies get much better. If you're overpaying for the expensive companies, then you have that headwind to move into. And if you're paying nothing or you're paying very little for those worst companies on the bottom, then they have this gradual improvement, and you should see multiple expansion that goes along with it. And that's deep value investing in a nutshell. Jeremy Grantham, who runs GMO, he's the G in GMO. He says that profit margins are probably the most mean reverting series in finance. And that's certainly something that we see regularly. He also goes on to say that if they don't mean revert, then something's gone very wrong with capitalism. I do some shorting as well. I'm often asked about the shorts. So I just to describe what I do when I short, folks assume because I'm a value investor that it's about overvaluation. It's not just about overvaluation, although that tends to accompany these companies. They tend to be very overvalued, but more important than that, it's very hard to work out what the value of these companies is, because often we'll find that their earnings are heavily manipulated. They're in some financial distress. There's some statistical indication of fraud. They'll be carrying an enormous amount of debt. They have lots of off-balance sheet liabilities. They've got weak or negative operating income and cash flows. And sometimes you'll find that their incomes are generated by one-off items, or they're selling some sort of credit. The question is, how do they continue to support themselves? Well, they tend to be very glamorous stocks. They're story stocks, and the way that they fund themselves is they issue stock and debt as they go along, and it's fed into the business. If you just use those preceding dot points, you lose a lot of money. In addition to all of those things, we look for broken momentum. So momentum is simply how much a stock has gone up over the course of a year. If we see a company has gone up a lot, it's got high momentum, and it's not a company that you want to short, we wait for the company to for the momentum to break, because we think that says that the market's getting tired of the story, and that makes it much, much harder for these companies to issue stock or raise debt. And that means that the catalyst for the short working is brought much closer, and that's a better time to initiate a short. This is a test, a very simple back test of the shorts. That this is all back test, to be clear. The shorts are 1/3 weighted, and you can see that when the market falls over, that tends to be the time when the shorts work best. So the shorts are on the top, and we use that as ballast against the long book. So when the long book goes down, the short book should go down more and provide more protection than its weight in the portfolio, and that's what a good short should do. As I mentioned earlier, it's been a very rough run for value. Everybody knows about that the growth stocks have done very well. It's a good time to be a tech company. It's a good time to be a high momentum company. It's a good time to be a very glamorous company. It's not a great time to be a value investor. This has happened before, the late 1990s looked very similar. This is the most expensive stocks and the most expensive decile and the cheapest decile. As you can see over the full period, the most expensive decile has so that the outperformance is long the value decile and short the growth decile, or the glamour decile, the expensive decile. Over the full data set, there's massive outperformance to value. But there are distinct periods where value has underperformed, and the orange line shows how far value gets behind the growth portfolio. And the value portfolio tends to underperform the growth portfolio about 80% of the time. It's just that over the full data set, when it works, value works so much better that it outperforms. So you can see there are very long periods of time where value does nothing. So from the late 1990s, value did terribly and then had a very good run in the early 2000s. We've encountered a similar period now. If anything, it's worse. The value companies have massively underperformed the growth companies. I don't know what happens yet, but it's my expectation that what has happened in the past happens again in the future, and we will see at some stage some value outperformance. But there are fewer and fewer believers in the value camp now. It's a little hard to see what's happening in this chart, but basically it shows the relative valuations of the Russell 1000 growth portfolio versus the Russell 1000 value portfolio. The reason for much of the underperformance over the last decade, value spent about 8 years being expensive, which is an unusual thing to say. I know that's difficult sometimes to visualize or to understand, but what that means basically is that there was a very long period of time where value did well at the beginning of the millennium, and it got expensive relative to growth stocks. And so it's been justly punished for about the last 8 years, until about 2 years ago, when now it's historically cheap. And it looks like at some stage when the growth momentum breaks down, it'll be a very good period to be a value investor again, because value now as a strategy is cheap. This is a slightly more confusing chart, but again, what this shows is that as value itself gets cheaper relative to growth, it tends to do much better. So all of the the better returns are seen when value is cheap as it is now. Let me leave that slide up short for a while. So if you have any questions, take all of that down and feel free to shoot me an email or get in contact through Twitter, and then I'll put my my own picture back up in a moment.
Okay. Well, Tobias, I don't know if I have time. I have just one question for you. It's a very
Sure.
short one. How many shares what's the diversification number of companies in a portfolio?
So that's a great question. It's one that I wrote an entire book trying to answer because it's not an easy question to answer. The academics will say, because the academics are looking at non-diversifiable risk, which is market risk versus diversifiable risk. And they say the objective is to eliminate all of your diversifiable risk. And the way that you do that is by each additional company that you add to your portfolio reduces your diversifiable risk. And their answer is somewhere between 20 and 30 companies. You've got the very vast bulk of the diversifiable risk is gone. Those studies were conducted in a time when it was expensive to create portfolios. And so it was expensive to create something like a market portfolio, an S&P 500 portfolio. Now it's a very simple matter to create that either by yourself through a free brokerage with fractional share ownership, or you can just buy an ETF. So the question then becomes, as a value investor, what's the best way to do that? In the book, we looked at various ways that value investors have done it over time. And one of them has been to Kelly weight the portfolio. So Kelly weighting is a edge over odds question. How good is this opportunity, and how much has the market missed how good an opportunity that this is? When you find that you have very good opportunities that are very cheaply priced, you should put more money into them. In short, there's some complicated mathematics that goes behind it. And I think that the problem with that complicated mathematics is it tends to lead folks to oversize these positions. When you add some more things in there, you'll reduce the size of them. But funnily enough, the answer still seems to be somewhere between 20 and 30 positions. In my own portfolio, I run 30 positions long and 30 positions short. And I think that that's a pretty good balance between the two.
Well, thank you very much, Tobias. It was a pleasure having you with us today. If anyone has another question, I'll take note of them. And thank you very much, Diana.
There's a few questions that I've seen here. Harry is asking Tobias, how do you see the present?
That's true. There's one here.
Right. How do you see the present stock market valuation and Apple?
Yeah, so that's a great question. The market is extremely expensive. Absent sort of, if we take away the backdrop of the level of where interest rates are, the market is extremely expensive. It's unusually, so we might use something that's a long-term measure of the market is the cyclically adjusted price earnings, which is Robert Shiller's measure. Robert Shiller just got a Nobel Prize for this. He basically looks at a 10-year average of inflation-adjusted earnings. And applying that measure to the market, I think it falls out at 33 or 34 times, which is in very expensive territory. It's really only been exceeded 1929, 2000, and today. So it's extremely expensive. This is in the US. The justification for it in the US is that interest rates are very low, and so it's difficult to find a yield or return anywhere. And so that seems to be the justification for it. The problem is that that doesn't change the fact that returns will be very reduced in future as well. If the market is expensive relative to the earnings that it will see in the future, the returns will still be very low. So in that context, the market is expensive. I think if you add into that the fact that there is probably enormous damage to the economy from the coronavirus and from the shutdowns, then I think that the market is possibly as expensive as it's ever been. The spread between the most overvalued and the most undervalued is as wide as it has ever been. So that's why I think folks have been piling into companies like Apple that Apple is a very good business. It's a global business, very high returns on invested capital, generates lots and lots of free cash flow that it has been demonstrated willingness to return to shareholders over time through share buybacks. I think Apple's extremely expensive, but Apple, and I think I think you can look at Apple on a price to earnings basis, and you can see that it's only been this expensive on one other occasion. And I think that was 2015. So Apple's extremely expensive. The market's extremely expensive. It's very hard to find companies that are as good as Apple, but as I think I demonstrated in this presentation,
they're undervalued.
The fact that the market is expensive, it doesn't mean that it can't get more expensive, but it is extremely expensive at the moment.
Okay. So
I do see another question here.
Yeah, but
I do see it.
Yes, there's a question here about the data. The question asks whether there is more recent data compared to the data used by Greenblatt. Greenblatt is 2011. I think in the book you covered something more recent until 2017, right?
Yeah, the book runs 2017. We're updating it. I've updated it regularly. I don't think we've updated it since Acquirers Multiple came out at the end of 2017, but that'll be something we'll probably release another edition on the 5-year anniversary, which is about 2 years away. I think that the question, what you're asking is what has happened in the interim, and I can tell you that it's been a better period for Acquirers Multiple type stocks. It's been a better period for pure return on invested capital stocks, and it's been a less good period for value. I did a podcast with a gentleman by the name of Mikhail Samanov. He runs a firm called 2 Centuries, and he's looked at 2 centuries of value performance. And what he has found is that there are these multiple periods of massive underperformance for value. And we're enduring one right now that is at least as big as the worst we've ever seen. It's considerably bigger than the 2000 drawdown, where this is a long short portfolio is underperforming by about 59%, which is as bad as it's ever been. It's possible that we've now gone through that bottom. So it's a very, very tough time to be a value investor. But on the other hand, it's also the opportunity set is about as good as it's ever been. It's comparable to where it was in 2000. So I'm very positive on the next 5 or 10 years for value. I think it'll be a very good time to be a value investor.
Okay, so now we covered all the questions. It was my mistake, sorry, because I have not realized that here I have one question to ask about the diversification. Well, Tobias, thank you very much for being with us today. It was an excellent presentation. And Diana, do you want to say some last words?
Yes, I want to thank you very much. I'm not going to pick any more cherries. No more cherry picking for me. And well, let's hope that the markets are going to be kind to us and that we choose wisely and follow an interesting model such as yours. Thank you very, very much for being with us. And let's try and do this again, maybe a few months from now or a year from now and see how the market's doing.
I think 1 year would be good. Thanks very much. Thanks, Augusto. Thanks, Diana. If folks want to get in contact, I can be reached through the email address or I'm on Twitter all the time at Greenbacked. I'm on LinkedIn, and I have a podcast. We bring it out Tuesday and Thursday, and you can see more on acquirersmultiple.com/podcast. Thanks, folks.
Wonderful. Hopefully we'll see your book published in Portuguese here in Brazil soon.
I'd love to do that.
Yeah, that's one thing that I would like to do. I'm still trying to find an editor to have a Portuguese version of it.
Augusto has the rights if he likes to. It'll be coming out with Augusto as translator.
So let's hope that we get those wheels turning and we have your book here in Brazil soon in Portuguese.
That'd be great. Thank you.
Great.
Thank you very much.
Seeing you. Thank you, Tobias,
Bye.
for your time with us.
My pleasure. Thanks,
Thank
folks.
you, Augusto.
Thank you. Bye-bye.